Did you know that a 1% cut in interest rates can save you thousands on a mortgage over the life of the loan? It's a game changer for your wallet. The recent decision by the Federal Reserve to cut interest rates has sparked a lot of discussion. What does this mean for everyday consumers like you and me? In this video, we'll dive into the impact of these rate cuts on your wallet. When the Federal Reserve cuts interest rates, it's making borrowing money cheaper and saving money less attractive. This can have a ripple effect on the entire economy. But before we get into the nitty-gritty, let's take a step back and understand why the Fed made this decision in the first place. The Federal Reserve has a dual mandate to promote maximum employment and price stability. With the current state of the economy, they're trying to strike a delicate balance between these two goals. The recent rate cut is a response to the slowing economy, trade tensions, and global uncertainty. By cutting interest rates, the Fed is hoping to stimulate economic growth and keep the good times rolling. Interest rate cuts have a ripple effect throughout the economy, influencing various sectors and industries. When the Fed reduces interest rates, it becomes cheaper for businesses to borrow money for expansion, hiring, and investment purposes. This increased economic activity can lead to job creation, higher consumer confidence, and ultimately, economic growth. Furthermore, lower interest rates make it more attractive for individuals to take out loans for big-ticket purchases, such as homes or vehicles, potentially stimulating consumer spending and driving demand for goods and services. In our next section, we'll explore how these rate cuts affect your personal finances. We'll break it down into 4 key areas: loans, savings, investments, and consumer spending. When it comes to loans, a rate cut is generally good news. With lower interest rates, your monthly mortgage payment, car loan, or credit card bill could decrease. This means more money in your pocket each month. On the other hand, if you have a variable rate loan, like a home equity line of credit or an adjustable rate mortgage, your interest rates could decrease, saving you money on interest payments over time. With fixed rate loans, like a 30-year mortgage, the impact may not be as immediate. However, a rate cut can make it easier to refinance your loan at a lower interest rate, saving you thousands in interest over the life of the loan. Savings, on the other hand, are a different story. A rate cut typically means lower interest rates on your savings account, CDs, and other deposit accounts. This means you'll earn less interest on your savings over time. You might be thinking, why does this matter? I'm not earning that much interest anyway. But for those living off their savings, this can have a significant impact on their income. Now, when it comes to investments, a rate cut can have a profound effect. With lower interest rates, the cost of borrowing for businesses decreases, making it easier for them to invest in growth and expansion. This can lead to higher stock prices and a stronger economy, benefiting shareholders and investors. However, some investors might feel the pinch, especially those relying on fixed income investments like bonds. Consumer spending is another critical area affected by rate cuts. With lower interest rates, consumers are more likely to borrow money to make big-ticket purchases, like cars or homes. This can boost consumer spending, which accounts for a significant portion of the economy. However, if consumers are already heavily indebted, a rate cut might not be enough to encourage them to take on more debt. This is especially true if they're struggling to make ends meet or saving for a big purchase. In addition to these 4 key areas, it's essential to consider the broader economic implications of rate cuts. Lower interest rates can lead to inflation, as more money is circulating in the economy. This can erode the purchasing power of your dollars. According to a report by the National Association of Realtors, a 1% cut in interest rates can increase housing prices by up to 10%. While this might be great for homeowners, it can make it harder for people to purchase homes, especially first-time buyers. Financial analysts have mixed opinions on the Fed's decision. Some argue that it's a necessary step to prevent a recession, while others believe it's a misguided attempt to stimulate the economy. For example, a recent article in the Wall Street Journal noted that the rate cut might not be enough to offset the negative impacts of the trade war on the economy. In a recent interview, a financial expert stated, "The Fed is trying to thread the needle between stimulating the economy and avoiding inflationary pressures." Another expert warned, the rate cut might lead to asset bubbles, as investors seek higher returns in a low interest rate environment. While there are valid arguments on both sides, it's essential to consider the potential risks of rate cuts, such as inflation and asset bubbles. To navigate the impact of interest rate cuts effectively, it's essential to adopt a proactive approach and consider the following strategies. Reevaluate your debt. Review your existing debts, such as mortgages, auto loans, and credit card balances. If you have variable rate loans, consider refinancing or consolidating your debt to take advantage of lower interest rates. Revisit your investment portfolio. Analyze your investment portfolio and consider diversifying your holdings. While lower interest rates may negatively impact fixed income investments, they could present opportunities in other asset classes, such as stocks or real estate. Explore alternative savings options. If your savings accounts or CDs are yielding lower returns, explore alternative savings options, such as money market accounts or high-yield online savings accounts, which may offer better rates. Consider home ownership. With lower mortgage rates, it may be an opportune time to explore home ownership or refinance your existing mortgage to potentially reduce your monthly payments. Maintain a balanced approach. While interest rate cuts can present opportunities, it's essential to maintain a balanced approach to your finances. Avoid taking on excessive debt or making impulsive investment decisions based solely on interest rate movements. In conclusion, the Fed's decision to cut interest rates can have a significant impact on your wallet. From loans to savings, investments to consumer spending, it's crucial to understand how these rate cuts affect your personal finances. The key takeaway is that rate cuts can be a double-edged sword. While they might save you money on loans and boost consumer spending, they can also lead to lower interest rates on your savings and potential inflation. Thanks for watching. What do you think about the Fed's decision to cut interest rates? Share your thoughts in the comments below. If you want to learn more about personal finance, check out our video on 10 simple ways to boost your savings.